Cold open, 10 seconds. The markets didn't explode, but they whispered a warning. A silent pivot in sentiment, a flicker of fear beneath the surface. This isn't a rally, it's a reckoning. INTRO, 10 seconds. I'm Raymond Bowie. This is your Qanexra Daily Brief. Yesterday's story, 60 seconds. Markets opened expecting a holiday bounce, fueled by whispers of Fed patience and corporate earnings season winding down. Traders crowded into tech, chasing the illusion of resilience in AI-driven stocks. But then the twist. A sudden retreat in semiconductors, led by NVIDIA's 2% dip, a signal that the AI renaissance is cracking under its own weight. By the close, the S&P 500 hung at 4,870, a fragile equilibrium between hope and hesitation. What's fascinating? The dollar staged a quiet comeback, rallying 0.3% against the euro. It wasn't a headline grab, but it was a message. Central banks aren't ignoring inflation, and investors are finally listening. Meanwhile, energy surged on OPEC plus hints of production cuts, a reminder that commodities still hold sway when the Fed's hand slips. But here's the rub. Volatility stayed muted. No panic, no euphoria. Just a market holding its breath, waiting for the next catalyst. And let me tell you, that's when the real drama begins. Raymond's take, 45 seconds. Here's what the smart money is thinking. This isn't a correction, it's a recalibration. Institutions are quietly rotating into defensive sectors, betting on a near-term slowdown. The Raymond swing levels? They're acting like a dam. The S&P's 4,850 mark is a psychological wall. Breaking below, it would send shockwaves through risk-on sentiment. What most traders missed. The rotation into healthcare and utilities isn't just a flight to safety. It's a strategic play. These sectors are trading at multi-year lows, and the math doesn't lie. If you're sitting on cash, you're missing the boat. But if you're buying now, you're dancing with a bear. Today's outlook, 30 seconds. While I'm watching this session is the 4,850 level. If we hold it, the market stays in survival mode. Break below, and we're staring down a cascade of selling. Also keep an eye on the dollar. Any sustained move above 1.0900 against the euro could ignite a broader sell-off. This isn't a day for timid bets. The market's whispering, we're not done yet. So ask yourself, are you ready when the storm hits? Close 10 seconds. Plan your trades, trade your plan. This is Raymond Bowie, Qanexra Capital. Deep Dive Masterclass. Australian dollar to Canadian dollar bullish trade setup. Spoken script, 3 minutes. Hashtag the narrative. Midnight to 0:45. Good morning. Today's focus is on the Australian dollar to Canadian dollar pair, currently trading at 0.9175 with a plus 0.09% daily gain. The broader macro environment is critical here. Australia's central bank remains hawkish, maintaining elevated interest rates to curb inflation, while Canada's Bank of Canada has signaled caution, keeping rates lower. This yield differential strengthens the AUD relative to the CAD. Additionally, global risk appetite is improving, driven by optimism around U.S.-China trade talks and energy sector stability. These factors underpin the bullish trend, supported by the pair's position above short-term moving averages. The RSI at 49.0 confirms neutrality but hints at potential for further upside, aligning with our confirmed bullish bias. Hashtag the technical structure, 0.45 to 1:30. Let's dissect the technical landscape. The Raymond swing pivot at 0.9167 serves as a key psychological level, acting as both support and a baseline for directional bias. Our entry at 0.91759 sits just above this pivot, signaling strength in the bullish trend. The immediate resistance, R1, is at 0.9176, a mere 1 pip above our entry, creating a tight cluster of liquidity. This proximity validates our entry choice. We're capitalizing on the pair's consolidation near R1, where institutional buying pressure is likely to push prices higher. The 0.382 Fibonacci retracement level at 0.9158 S1 provides a clear stop-loss anchor, guarding against a potential reversal. With an average daily range, ADR, of 0.0023, the market's volatility is contained, allowing precise risk management. The alignment of exponential moving averages, EMAs, further reinforces the bullish structure, confirming the trend's sustainability. Hashtag the psychology, 130 to 215. Now, let's explore the behavioral dynamics. Retail traders often gravitate toward pivotal levels like R1 and S1, placing trades based on fear of missing out, FOMO, or overreaction to news. In this case, those who entered near S1, 0.9158, may now face whipsaw action as the price approaches R1. Conversely, traders holding longs below the pivot might panic if the pair pulls back toward S1, mistaking a temporary correction for a bearish reversal. This creates a trap for sentiment-driven players. The bullish trend remains intact, yet emotional biases could force premature exits. Moreover, the narrow ADR suggests limited volatility, reducing the likelihood of sharp reversals. Those anchored to rigid stop-loss placements below S1 risk exiting at a loss if the trend continues upward. The key takeaway? Discipline is paramount. Let the price action dictate decisions, not fear or greed. Hashtag the trade plan, 2:15 to 3 o'clock. Execution details. Enter a long position at 0.91759, targeting 0.9267659 with a stop-loss at 0.913000205. Why these levels? The take profit at 0.9267659 aligns with the next major resistance zone, where institutional liquidity is expected to congregate. This level also coincides with a key Fibonacci extension, 1.618, amplifying its significance as a profit-taking point. The stop-loss at 0.913000205 safeguards against a breakdown below S1, preserving capital in case the bullish momentum falters. Risk-reward ratio stands at approximately 1 minute and 1.5 seconds, offering favorable odds. Monitoring volume near R1 will confirm institutional participation. A surge in buy orders will validate the uptrend. If the price breaches R1 and holds above the pivot, the target becomes increasingly attainable. Stay vigilant for signs of exhaustion, such as a declining RSI or divergence in EMAs, which would signal a potential pause. This trade is a high-probability play on the current bullish structure, leveraging macro fundamentals, technical clarity, and behavioral psychology. End of analysis. Word count, 950 duration, 3 minutes. Check the full track record at Qanexra.com/signals.